So I started my firm in 2000. I'd had a 18-year career as an investment banker at a firm called Alex Brown and Sons. And Alex Brown was bought twice in 2 years. The first was a transaction with Bankers Trust. And subsequent to that transaction in 1998, probably most people don't remember long-term capital management, but I remember it vividly because our merged stock went from 145 to 45 over the course of 3 months. And bankruptcy was allegedly around the corner. We were rescued by Deutsche Bank in the spring of '99 at $93 a share in cash. And I left at the end of '99 after 18 years at a wonderful firm, actually 16 great years and 2 not so great years, and decided that I would start an investment management company investing in early stage venture capital in 2000. And I didn't really have any business starting an investment management firm, but it was the height of the internet bubble. And somehow or another, with no office and no employees, I raised $114 million, which closed in March of 2000, 2 weeks before the NASDAQ hit 5,000. So sometimes timing is everything. So Alex Brown was a unique firm. When I joined the firm, there were 10 of us in investment banking. My first job was as Chief Financial Officer of ABS Ventures, the original micro VC, I call it today. It had $23 million under management. We were a leading underwriter of initial public offerings, and we were the leading underwriter of venture-backed initial public offerings, and the year 1999 we did 100 IPOs, which probably is more IPOs than have been done since then in like 10 years in technology. But in any event, along the way, I started investing in funds on behalf of myself and some colleagues at Alex Brown, mostly with friends, small amounts of money. So that really was the impetus for starting Accolade Partners formally as a fund of funds, and transitioned some of the positions that we had and relationships with some managers from those legacy portfolios that we had into what was Accolade One, which was a 2000 vintage early stage fund of funds. Our fund of funds are fairly small and we have very concentrated positions, but over the last couple of years we've added a handful of new managers, and each time we're in a position to do a re-up with an existing manager. We do re-underwrite that decision, and we have lost some managers along the way, and so our funds have gotten larger modestly over time, which enables us to add a handful of managers. So I think we've added 6 over the last couple of years and lost a couple along the way. We have very fortunate to have a great stable of existing managers. So we are principally in the business of portfolio construction. So we always look to diversify what it is that we already have and want things that are accretive to the portfolio. So we added a second manager in biotechnology. We think that's an area with very strong tailwinds, and so we were fortunate to find a new manager in that space. We think that financial technology is a space that's really interesting. We were able to invest with extremely seasoned executive who took outside capital for the first time in 10 years. So that's accretive to our portfolio. We backed a team that has a foundry model in artificial intelligence, but it's a team that has been working in that field for a long time and thought their approach in company creation and deep domain expertise in machine learning and artificial intelligence merited us making an investment in that sector. So, as I said earlier, venture capital is a very dynamic asset class. There are always opportunities that emerge. AI was not an investable sector 10 years ago. Fintech existed, but I don't think there were that many opportunities for a dedicated manager in that space. And so, these are nice things to be able to add to the portfolio versus, for example, adding another Series A manager that does enterprise software where we have lots of exposure already. And by the way, when we chose to invest, for example, in financial technology, we looked at everything in financial technology. I think thematic investing is tricky. We're not in the business of picking the themes. We're really backing teams that have deep domain expertise in what we view as big opportunities. So we're not looking for a fund that does X. We're mostly attracted to the fact that, you know, in both the cases, in AI, it was started by a company CEO that we had known for 10 years that had been an incredible CEO and had generated a great return for one of our managers. And so I think we're backing that team, and similarly the team that we backed in fintech, you know, we backed the team and figured they're going to know what opportunities there are. I guess the only area we did add to the portfolio in biotechnology, because, you know, over the last 5 years it's been a very good sector, you know, in the public market. There's some fundamental tailwinds in terms of next generation technologies like CRISPR, like CAR T therapy, et cetera, that you know, will provide for great outcomes and, you know, a very favorable exit environment, both through IPOs and also through acquisitions, because pharma and biotech companies need product. And so we think about that a lot. We think a lot about our exit opportunities. And so, but we don't have any specific agenda in terms of, you know, we need to add X.